is pricing both $130 and $90 at the same time. That is not a trading range, that is a war premium. According to active polymarket contracts, live bets exist simultaneously on WTI hitting $130 in May and $90 by end of June. Markets have no consensus, and that spread tells you everything about the uncertainty priced in right now. Here is why this hits Korea harder than most. The country imports nearly all of its crude oil. This morning, South Korea's Ministry of Trade cut mandatory private sector crude stockpile days from 40 down to 20. According to the ministry briefing that releases approximately 12 million barrels in coordination with the IEA. The sovereign strategic reserve stays untouched, held back as a last resort, signaling the government expects this conflict to run long. The Bank of Korea also this morning raised its 2026 GDP forecast from 2.0 to 2.6%. That upgrade assumes Middle East tensions ease gradually and Hormuz Strait traffic recovers by Q4, an assumption that is now fragile. Here is why that matters. If oil stays elevated, the chain runs. Energy costs, utility tariff hikes, CPI, and then rate hike pressure on the bouquet. One weakness gives Korean exporters a short-term competitiveness edge, but rising import input costs squeeze margins on the back end. For U.S. investors, watch XLE and the $100 pivot level in oil futures and track the polymarket Hormuz contract as a real-time conflict gauge. Korea just cut its energy buffer in half mid-conflict, betting on IEA coordination to hold. The oil market is now the judge.